Most beginners think that commercial real estate and residential real estate are the same way for down payments, but that is totally wrong. Now, in residential real estate, you can definitely do 0 to 20% down. Commercial real estate, though, the rule of thumb is more like 20 to 40. I'm going to break down for you each and every asset class, at least the main ones, for you in this video, what to expect for down payment, and why they are that way, how to decrease them as well to use better deals moving forward. My team's done $1.6 billion in transactions over the past few years. I've seen so many deals almost die because they did not understand what it would be for down payments, which affects everything. And not only just down payments, but also terms. So this will be a super impactful video to help you save hundreds of thousands of dollars, if not millions of dollars in your career as an investor, especially in commercial real estate. So let's hop in to what this looks like. So again, I'm going to break down asset types and common down payments from multifamily, industrial, retail, office, self-storage, hotel, mixed use, special purposes, which is a huge category, and of course also some unique options for you as well for more context. Because let's face it, it is possible to buy commercial real estate for 0% down up to 10% down. Yes, you heard that right. You can, but it's unique situations, which I'll cover here pretty shortly. So stay to the end to watch that one. You want to love that massive savings for yourself. Now, we come down to multifamily. This is one of the most known asset classes. It's one step above residential real estate. So 20 to 30% is pretty possible, super reasonable. Proven cash flow, agency debt available. There's so many services out there who would love to loan you money for multifamily. Now, at the same coin, though, each of these also depend on loan terms. Sometimes it could be 15 years, 20 years, 30 years, and all of these makes a massive difference when you're doing underwriting. Now, up above, a whole video that breaks down underwriting for you from A to Z how to do that. This is breaking down payments. It's not overwhelming you too much in one video. But you will make sure you understand, is it properly going to cash flow for you, yes or no? If it does, you can have less terms. If it doesn't, it's higher terms. And I'll break down all this more detail for you too at the end of the video for more context on how this works. Now, our next one is industrial. Now, industrial, I think, is a super powerful investment strategy, and I do anticipate it being a mainstream, asset class in the next 5 to 15 years. Because you think about real estate, normally, once it becomes popular, you have these gurus and online influencers. That's what the main business model is, selling masterminds and programs. I have lots of friends to do that. I'm not hating against them. It's just the business model. And it's a good business model. But that normally picks up a big trend of, storage units or multifamily because people are talking about it more often. And soon, this will be the same. But for now, you're probably going to expect to see a 20 to 30% down payment for this one as well. It has strong tenant demand, lower management risk, and banks understand these. They've seen these time and time again for eons. You think about industrial, this is what America was built on. It was on industrial real estate. So, really popular class, 23% down payments. Next on our list is retail. Retail is actually higher than you think it would be, 25 to 35%, because you have tenant risk and lease rollover sensitivity. Sometimes you can have a lease term that is 3, 5, 10, 15 years or longer, and you might be buying it towards the end of that lease term. Or you could be having a lease that expires, in 5 years, but after that 5-year period, finding a new person may be hard. Now, I have a whole video I broke down before talking about this particular asset class in more detail for you. But when you have retail, this takes the coffee shop. you have to like change the way the building is structured to accommodate that tenant. And that can make it even harder for you as well to get more tenants that are not like those in the future. So again, this is why you see a higher down payment for your retail, 25, 35%. Next on our list is office spaces, especially right now. You can probably expect to see 30 to 40%, sometimes 50%. Vacancy risk is a lender caution today. This is why we see this. It's all because we have a massive, scarcity. People don't know what to do with these. You buy an office space, then well, what do I do with it? Now, I'm not saying offices are bad. Again, a whole video I broke down before talking about office spaces. You can find 8, 9, 10 caps, cash flow day one, triple net, super popular. But I'm referring to more on the risky ones, so like downtown Austin, Texas, where I'm at right now. Down there, these offices are not being used and they're massive, tens of millions of dollars, if not hundreds of millions of dollars worth of assets that just buying them and then trying to convert them later on is a hard task. Which is why you see this. Down payment is a lender's risk, mitigation and not a favor to you. Let that really sink in. When you think about down payments, the reason why we have down payments is not to make our lives easier. It is to make the bank's life easier. It is a risk mitigation. They say, hey, put some skin in the game, so I know that if you default, we're still protected to some degree. And also it makes the loans a little bit better. Let's say if the DSCR is 1.1 at 10% down, but at 20% down it's 1.25. Now it can give you a loan and it's more trustworthy. So this is why it's so important to understand that loans or down payments are mostly for them, not for us. Really good rule of thumb to follow. And of course, you want more help and more support, down below, link in the description. Call me directly. I have more to cover in this video, but I know some people want it all done for them, and I do all that for you. Sourcing the deal, underwriting the deal, the whole 9 yards, help you save at least 5 to 6 figures in your next investment. And if you don't, I work for free, and so far, all my clients we've worked with, from family offices, institutional buyers, and in between and beyond, have saved a minimum of 5+ figures with our help and support. No obligations. If they want that, down below, link in the description. Let's get back to our video. Now that office spaces, again, vacancy risk is a big part of that, and so is lender costing today. Next on our list is self-storage, also super popular investment strategy right now. 25 to 30% is probably pretty typical. I just did a deal right now. I'm actually under contract to close here shortly on 2 of these, and that one on a contract last week for $3 million. And that one we're doing 10% down. But we have amazing terms. Like the DSCR is like 1.4 at 10% because we did crazy negotiations. We saved our client over $375,000 off the ask price on an already good asset. Like it was already pretty solid returns when we found it, and we negotiated another almost $400K off the ask price. And because of that, we can now do a unique loan more than that pretty soon. But typically 25 to 30% for self-storage. It really comes down to the operational, intensity, strong or not. Cause like in some markets, it's you have high demand, but a lot of times you can find these storage units or the operationals, the OpEx are terrible, but has strong margins. So banks will kind of go back and forth. You can do 20% a lot of times for self-storage as well. Really common there, and again, less. But also know about your lease terms. Now, this is just not, I'll be wholly about this pretty soon, but for more context for you watching this, lease terms, again, vary. Like it'd be 10 years, 15 years, 20 years, 25 years, and beyond. And for self-storage, a lot of times, 15, 20 years is kind of standard, especially on older storage units. If it's Class A, high Class B, newer unit, maybe it can be 20, 25, but expect it to be a big part of that. That will change a lot on your net free cash flow if you're investing in real estate. Next one is hotels. This one is going to be operational plus economic cycle risks. Like you think about the Hilton, they probably got good terms because it's a really popular hotel. But if you're buying a boutique hotel, you might see higher risks, 30 to 40%, because it is a gamble. It is a business. Like you're buying a legit business. And on that note, another side thing too is when you're buying commercial real estate, I'm going to come out for this one. A lot of investors, especially the beginners, never know about this. When you invest in commercial real estate, you have two loans a lot of times, depending on the bank you work with. One loan is for the commercial asset itself, buying the building, buying the asset. And then another loan, a lot of times, is going to be for the business because they're valued differently. This is a really common thing that most new commercial real estate investors never realize until after it's too late. They have to scramble last minute to adjust numbers, to fix things. And those two loans will have different loan terms from the interest rates and so forth in terms. Now, on top of that, there are ways to avoid that. If we're buying a commercial asset and that asset is valued so high that it pays for the business and for the real estate, you're great. It's one single loan. But if it doesn't if it's not equate to that number, well, then you're going to have obviously a high both of these two loans at the same exact time. So it's really important to understand that as well. Not really down payment, obviously, but still good to keep in mind. Next one is mixed use and special purposes. 30 to 45%. It's hard to underwrite. It is resale. So this is why I think I love mixed uses and special purposes a lot. These are churches. These are hotels, which is special purposes. Storage units are in a way kind of special purposes as well. But this is a large list of different strategies used. Industrial is also form for mixed use. But again, for most people, they are hard to underwrite, especially like a church. How you underwrite a church is kind of hard to do. So you can see why you have a higher down payment. Again, a down payment is a risk mitigation for the banks and for the lenders. It's not a favor to us. So this is why it's so high for these. Now, if you can give them a good plan, obviously that will change the down payment for you as well. And the last one on this list, until we break down the loan structures, how to change them to get better terms, unique options. Unique options is 0 to 10% down. So these are great. However, they're harder to find. This is SBA, a seller bank loan. This is a loan from a small business that was given to you for 10% down on a property. And they take longer. So, if you want to close quickly, do the SBA. It's probably pretty hard to do. And also to keep in mind as well that just because it's less doesn't always mean it's better. Because that will greatly affect your down payment, your out-of-pocket expenses. It will affect also your cash flow. If I am not putting down more money on the property, then my NOI would be eaten up a lot by my debt servicing, because my debt is now higher than it would be with a 20% down payment. So again, keep that in mind. Less is not always more. If you cannot afford to buy a property at 20% down, and you need to do 10% down, you might want to reconsider the price range you're looking at and buy a smaller unit. There's no, glory buying massive properties for your first one. Buy a small one that still cash flows than what you want it to do and has the same returns of dollar to dollar. It's still great, and you can scale up as you grow and get more appreciation and more equity. Next one is seller financing. Seller financing is also a really popular strategy. It's when you're carrying a note or carrying from the seller. The seller says, hey, I will be your bank. Give me X amount down payment, risk for them mitigation, and then you can have this property at these terms. This is also a popular strategy. Also, a side note, you have sub-twos, which is still happening. Even in commercial real estate, we can wrap the loan they have in your name to create a strategy, and that way you have no new banks involved, which is also good for, just your whole debt to income ratio. Next one is assumable loans, kind of similar to a sub 2, but more formal when they actually talk to a lender. Takes more time, but say, hey, you have a 3%, 4% loan right now, and the remaining amount is 80%. I want to assume that loan and make a new loan for the remaining 10, 20%, depending on the down payment. So another thing to keep in mind when you're doing assumable loans, you have two loans. You have the main loan that they already hold in place. If it's 80, 70, 60%, you assume that loan, but you need a new loan as well for the remaining amount that's not on that current one. So you do have differences there. And then of course you have JV, which is joint ventures, which is another way to get more, options to buy more properties and using capital stacks. Now let's cover what loan types you have in terms of like facilities. You have banks and credit unions. These people will normally give you 25 to 35% down, sometimes 20. This is all about relationships. Super big relationships. They're super conservative in underwriting. A lot of times they're smaller banks as well. So they're really, really big. So the numbers are going to be safe for them because it is a investment. That's what they're doing, making a bet, a gamble with you doing a good job. And of course, all of these also will take into account your background. Like you have no scheduled real estate, which is a form that we use to say your resume, well then that will also affect if they give you a loan or not, and at what terms do you get them for. So you have more criterias, more experience, a good broker like myself to help you do these who they trust already, that also affects it as well for you too. I do right now that my client, he should be probably doing 30% down easily on this property, but we got it for 10% down because I've done $1.6 billion transactions with them being a big part of my bank, with them, with my transactions, me and my team that I run. That's why we got a lower rates, because they already trust me, know who I am, they know I vetted my clients beforehand to get them better terms. So relationships driven is huge. Next one is agency. This is Fannie and Freddie and multifamily only for this one. This is 23% down. This is the best leverage, best pricing if there qualifies. You have CMBS, which is commercial lending. This is 25 to 35% down, non-recourse, rigid structures. Has to be super on point when it comes to investing in an asset to know, okay, this is worth it. I will marry this bank. Next one is debt funds and bridge, private money and hard money as well, being part of this too. This is 30 to 40% down, effective equity, higher leverage sometimes, but priced for risk. So again, this is a higher amount, but it's for quick reactions. Normally, when you do a bridge especially, you want to refinance not long afterwards to get money back even faster. This for super quick close. And then what actually affects down payments? This is super crucial. There are a few main ones. So equity requirements, if the DSCR is below 1.25, which means you make 25 cents per dollar, more per dollar on what you have in assets. So when you do DSCR, it's like my NOI is $100,000 and my debt servicing is $75,000. I have a 1.25% now on my DSCR, so I can get a loan for it. I make more money that gives me cash flow and pays for the property itself. Makes it a safe investment. If it's $100K for my NOI and $100K for my debt servicing, it's a 1. They won't give you a loan for that because it's too risky. Well, they will if you have a good net worth, good criterias, good resume, and you can good money in the bank. But they don't want to if you're not a safe candidate for that. If you can find 1.5, a 2 DSCR, they will give you a loan at the best terms ever because they know it will pay for itself. It's a good investment. So that is a huge, huge part. If you can get a good DSCR, your down payment will change a lot. That's why for my clients, a lot of times we get really good loan terms because I negotiate so aggressively that we get a great DSCR day one. Another one is just short WALE or lease rollover risk. This WALE is weighted average lease expiries, meaning that the lease expires in 3, 5, 10 years from now, probably less than that, and they're worried about it having a new person come in later on, which will affect the down payment. I mean, it's risky. You might lose money for an amount of time before you get a new tenant in there. Tenant concentration, this is going to be based on if it really places like there is apartment complex, but next door there's like 50 more apartment complexes in the same block. That will affect your down payments. If you're a traditional market, so the third-party market, so for us in Austin, Texas, and this sound like Pax Buda and like Wimberley, that may affect things. I mean, the market is pretty far away, not a lot of stuff going on there. It's going to be a smaller, buyer pool. And of course, another thing for you too, we can help you in all 50 states. I'm in Austin, Texas. We do deals all across America. For another side note for you. Heavy CapEx or deferred maintenance too can be a massive part of why your down payment is higher. So if you have like a new roof to be replaced or the place hasn't been upkept for 20 years, that will also affect a lot of your down payment structures. Offices, of course, will always be high for right now, or soft retail exposure too. And then they will reduce equity, again, if you have a strong in place cash flow. If the property makes you money day one, they will happily give you a loan, but it pays for itself. If it's institutional quality assets, so Class A, this is like, low cap rates, but they are a strong property, great terms, no repairs needed, it is brand new, great terms for that one. Top tier markets, so Austin, Texas, Miami, New York, all these places like that, you get great terms there because they know it's a strong market there, high appreciation rate, and normally safe bets. Or also experienced sponsors. And this happens a lot in commercial real estate. We have somebody who's really, really experienced, say, hey, I will be your sponsor, kind of like your co-signer in a way, on this property. Say, hey, you're protected, I'm working with them as well, plus also you're a broker too. And those are the big breakdowns. So again, we covered multifamily, industrial, retail, office, self-storage, hotel, mixed use, special purposes, unique options, and of course also what determines the loan structures. And rule of thumb, when you look at this, you can normally expect to see a 20 to 40% down payment on commercial real estate, and as low as 0 to 10% down, depending on how you structure things creatively. But if this is helpful for you, down below, leave a comment. What was your favorite asset class on this list? And what are you looking for? You're looking for self-storage, hotels, I'd love to see your comments down below. And of course, this is helpful for you as well. Make sure you smack the like button, tell your friends, here's the sale. Over here, a whole video that breaks down the A to Z for you as well on all things actually doing deals, investing in commercial real estate, so much more for you, and a whole playlist for you as well. And of course, thanks for watching. For the best day yet, I'll see you at the top. Glad to have you here.